Have you ever wondered what happens when a Canadian company buys inventory from the US or borrows money in Japanese yen? How do we deal with the fact that exchange rates keep changing? Well, that's what we're diving into today. Foreign currency transactions. One of those topics that seem intimidating at first, but once you break it down, it's actually very logical. Here is our game plan. We are going to go from the definition, initial and subsequent measurement, to IFRS versus ASPE differences. Before we jump in, don't forget to like this video, subscribe to Canada Accounting Insights, and hit the bell icon so you don't miss any of our future videos. Let's start simple. A foreign currency transaction happens whenever a company deals in a currency different from its normal operating currency, what we call its functional currency. For example, a Canadian company sells goods to a French retailer and requests payment in Canadian dollars. That's still a foreign transaction, but denominated in CAD. Or a Canadian company buys equipment from a US supplier and agrees to pay in US dollars. That's also a foreign currency transaction. The main objective is to make sure the transaction's impact is accurately reflected in the company's books in Canadian dollars, and that exchange rate changes are handled properly over time. Now that we know what qualifies as a foreign currency transaction, let's talk about how those exchange rates actually work. Before we can record anything, we need to understand exchange rates. There are two ways to quote them. Direct quotation. This shows how many Canadian dollars you need to buy 1 unit of foreign currency. Example, 1 US dollar equals 1.41 Canadian dollars. So, if you buy goods for 1 million US dollars, that's 1,410,000 Canadian dollars. Indirect quotation. This flips the perspective. It shows how many foreign currency units you get for 1 Canadian dollar. Example, 1 Canadian dollar equals 0.7092 US dollars. In Canada, we usually use direct quotations because it's easier when recording transactions. Example, Riverbend Imports Inc. owes 7,500 US dollars. If the rate is 1 Canadian dollar equals 0.8027 US dollars, divide 7,500 by 0.8027 equals 9,343.47 Canadian dollars. Or convert it to a direct rate. US dollar 1 equals Canadian dollar 1.2458, and multiply 7,500 times 1.2458 equals Canadian dollars 9,343.50. Pretty close, just rounding differences. So now that you know how to interpret exchange rates, the next step is figuring out which currency you actually operate in. Under IAS 21, the first step is to figure out the company's functional currency, the currency of the primary economic environment where it operates. For most Canadian companies, that's the Canadian dollar. The currency you present your financial statements in is called your presentation currency, which is often the same, but not always. For example, a Canadian subsidiary of a US parent might have CAD as its functional currency, but present its results in USD to align with the parent company. Once you know the functional currency, the next step is to translate the transaction into that currency using the exchange rate on the date of the transaction, also called the spot rate. If there are many transactions occurring evenly throughout a period, an average rate may be used, as long as the rate doesn't fluctuate too much. For time-based revenues or expenses, like interest, we also use the average rate for the period since it accrues evenly. Example, Northern Maple Limited purchases inventory from a US supplier for 100,000 US dollars on December 15th. On December 15th, we record debit inventory 125,000, credit accounts payable 125,000. The purchase is locked in at that day's rate, 125,000 Canadian dollars. But what happens when the exchange rate changes before the bill is paid? That brings us to the next part, subsequent measurement. Now comes the tricky part. What happens after initial recognition? Foreign currency transactions can involve two types of items, monetary and non-monetary. Monetary items are things that will be received or paid in a fixed amount of currency, like cash, receivables, payables, loans. These are remeasured at the closing exchange rate, the spot rate at the balance sheet date. Any resulting gain or loss is recognized in profit or loss for that period. Example, Harborview Enterprises Inc. borrowed 100 million yen at 10% interest. At the start, the loan is recorded at 1,100,000 Canadian dollars. At year end, the lower rate reduces the loan's CAD equivalent. That's a foreign exchange gain. Next year, when the rate rises, it becomes a loss. So monetary items fluctuate with exchange rate changes, but what about assets that don't? Let's talk about non-monetary items next. Non-monetary items, on the other hand, aren't revalued at the closing rate. These include inventory, prepaid expenses, property, plant and equipment, intangible assets. They're usually measured at historical cost, meaning they stay at the rate from the purchase date until derecognition. Example, Prairie Goods Inc. buys inventory for $100,000 at 1.25 on December 15th. By year end, $1 equals 1.21 Canadian dollars. The inventory remains $125,000, but the accounts payable, being monetary, adjusts to $121,000. That difference of $4,000 is a foreign exchange gain. But what if an asset is measured at fair value instead of historical cost? That's where the rules slightly change. If a non-monetary item is carried at fair value, like revalued land or investment property, the translation uses the rate at the date of revaluation, not the closing rate. Example, Cedar Valley Properties. Limited buys Swiss land for 1,300,000 Swiss francs at 1.45 equals 1,885,000 Canadian dollars. At year end, it's revalued to 1,650,000 Swiss francs at 1.41 equals 2,326,500 Canadian dollars. The total gain of $441,500, including the exchange component, is recognized in OCI as a revaluation gain. Now that we've seen how to measure both monetary and non-monetary items, let's see what happens when the transaction finally comes to an end. Derecognition. When an asset or liability is finally settled, we derecognize it. Monetary items are updated to the spot rate on the date of settlement. Non-monetary items stay at historical cost. Example, Summit Supply Corp. Pays its $100,000 payable on January 15th when the rate is 1.20. Previously, the payable was $121,000 at year end, so we record a $1,000 gain on payment. Meanwhile, the inventory stays at $125,000 until sold. When sold for $160,000, normal entries are recorded for COGS, inventory, and revenue. No exchange gain or loss there. So, only the monetary side fluctuates with exchange rates. The non-monetary stays locked in. Once the transactions are translated and recorded, the next question is, how do we show this in the financial statements? After translation, all amounts are presented in Canadian dollars in the financial statements. Under IAS 21, the entity must disclose its functional currency, the amount of exchange gains or losses in the statement of comprehensive income, and, if there's a change in functional currency, the reason and nature of that change. Simple but essential disclosures to keep users informed. Now let's quickly see how this compares under ASPE. Under ASPE 1651, the rules are very similar to IFRS 21. The main difference is with non-monetary items at fair value, IFRS uses the rate at the date when the fair value was determined. ASPE uses the rate at the balance sheet date. In practice, this often gives the same result, since fair values are usually determined at year end. Example, Glacier Tech Ltd buys German equipment for €200,000. On April 29th, €1 equals 1 Canadian dollar 50 cents. On May 28th, when payment is made, €1 equals 1 Canadian dollar 56 cents. On April 29th, we record debit equipment $300,000, credit accounts payable $300,000. Then, on May 28th, debit foreign exchange loss $12,000, credit accounts payable $12,000, debit accounts payable $312,000, credit cash $312,000. At year end, Glacier Tech records normal amortization, just like any other fixed asset. Now that we've seen both frameworks, let's bring it all together with a quick summary. Let's recap the 3 key steps under IAS 21. Determine the functional currency. Translate transactions using the spot rate at the transaction date. Revalue monetary items at the closing rate, with any gains or losses going to profit or loss. And remember, Non-monetary items generally stay fixed unless they're revalued at fair value. So there you have it. Foreign currency transactions under IFRS and ASPE made simple. We went from basic concepts all the way to full examples with journal entries. If this video helped you understand how to handle exchange gains and losses, give it a thumbs up, share it with your classmates or colleagues, and don't forget to subscribe to Canada Accounting Insights for more CPA-style accounting tutorials. Thanks for watching, and I'll see you in the next one.